milking rats! Milking rats!
Rats? I'm outraged. You promised me dog or higher.
Hey guys, Raf here from the End Game Investor, and time is growing short. We are heading into the final price inflationary phase of this monetary system, I think, as judged by the new wave in price inflation, consumer price inflation. I know inflation is money printing, but I'm talking about consumer prices here. And this is being echoed in a change of heart by a whole bunch of economists that were surveyed by FT, I think yesterday or 2 days ago. They are changing their minds. They believe that the Fed will not pause its interest rate hikes. It will rather continue down the interest rate hiking road because they see a new wave of consumer prices rising. We're going to compare this with the 1970s. Could we be at that inflection point where higher interest rates go from causing consumer prices to fall by smashing demand and the marginal debtors to where they encourage prices to rise because they choke off supply faster than they choke off even more demand? I think we are at that point, and mainstream Keynesian economists are starting to see it also. And I think this is great for gold, even in the short term, because it means that if the Fed does raise rates coming this week at their FOMC meeting, it will show a sign of desperation when everyone was expecting them to stop raising rates, and now they're raising rates, which means they fear inflation, which could drive the gold market a little bit nutty, maybe. I mean, I'm not a short-term trader. I'm not a short-term timer, but this quick change in sentiment could reverse the gold market a lot higher and break through those highs at 2080 pretty quickly. Will it definitely happen? No, nothing is definite. But on the other hand, if they don't raise rates while economists are expecting it, then expectations for a more consumer price inflation rise and gold goes up anyway. So I think we're in a point, we're at a pivot point, we're at an inflection point where no matter what the Fed does, gold goes higher. This is not advice. This is just my feeling. And if you want to acquire your physical gold and silver, do so with MilesFranklin. They are trustworthy, they are quick, and they will not rip you off with numismatic high premium stuff. They just sell bullion, which is what you need in this environment. We do not need art made out of bullion. We need actual money at the lowest premium possible. They have never had a complaint in the Better Business Bureau. They are a near perfect company. So call 855-GAME-N to acquire your gold and silver with them and mention the Endgame Investor and support me and my work and everyone who works with me, which is MilesFranklin. And second, the reverse repos, the extra dollar reserve tank is now plummeting very, very quickly, which should mean that the money supply is rising as money goes out of the reverse repo facility, which is outside of the money system, outside of the banking system, and goes back into it. But we are not seeing a rise in money supply, probably because these reverse repos are being taken out of that facility and put into the banking system to plug, this is my assumption, to plug holes in the balance sheet of big banks that are getting defaulted on by loans, whether they be mortgages or auto loans or whatever they might be. If we're seeing defaults and money move back into the system from reverse repos at the same time, we should see a plummeting reverse repo supply, which we are seeing, and a static money supply, which we are seeing. At this rate, the reverse repo tank gets emptied in about 5.5 months, which is January, February. But I think if there are defaults, it will accelerate and that tank will empty even sooner. And once that tank is empty, there are no more spare dollars to use and you end up in the next financial crisis. So we are months away from that at most, I think. And this is not advice. These are just my entertaining calculations. And ask a professional who knows a lot, more than me. Everybody knows more than me. I know very, very little. So let's look at these little charts, and we're going to go through some little inflections. So first of all, here we have the 1970s, the two inflationary waves, the two inflationary trends. It came in two major waves. There was one in the early 1970s, but it was a much more minor. That was just when Nixon closed the gold window in 1971. So here you have the first wave, which we go from about, let's say, 2.5%. And look, the caveat or my disclaimer on these numbers are that I know that the CPI is crap. I know it's crap. I'm not saying that it's accurate.
Crap on a crutch!
But as crappy as it is, it does show trends, and the trends are what I am interested in here. We know that there was severe price inflation from 1972 around to 1970. 1974, just before 1975. And we know that there was severe price inflation from about 1977 to 1980, as we see on this chart. Exactly what the numbers were doesn't matter. I'm talking about the trends. So the CPI is accurate in that it does show that when price inflation goes up, when consumer prices go up, the CPI goes up. And that's all I care about. So from 1972 to about 1974, for 30 months, 1975 maybe, we head up here for a period of 30 months, and then we go down between 24 and 40 months, depending whether you want to see this as a little blip or not. So let's just say 24 months, and then we're static for about here. And then we head up for another 23 months, and this is when gold tops at 872 and silver tops at $50. This was the point where the dollar almost completely imploded, and we almost lost the fiat dollar, the so-called fiat dollar, which is really still a gold derivative, but that's my thing. And now we're going to go into the 2020 trends. Could we be repeating this? And, history never repeats, but it rhymes, and that's a cliche and it's hackneyed. I'm sorry. Anyway, the 2020 trends. We saw at the peak of the deflationary panic, right? Did the CPI go negative? No, it was still positive. Consumer prices were still rising year over year, even at the March 2020 complete lockdown crazy panic. So we have here for 25 months, consumer prices start rising from about March 2020 until April 2022, and then we go down for about 12 months, and now we are headed higher. Now this could be a blip, or it could be the start of a new trend. And one of the reasons why I think it is the start of a new trend is that the Keynesian economists are starting to chime in that they also believe that price inflation is headed back higher, and for that we will go to the FT. We have here, economists expect Fed to defy investors with more interest rate rises. FT Booth survey finds majority of economists think central bank has more work to do to lower inflation. This article was published yesterday. What is yesterday? Today is September 18th, so September 17th by Eva Zhao and Colby Smith. So the first paragraph says the U.S. Federal Reserve will defy investors' expectations and raise interest rates by at least another quarter point, according to a majority of leading academic economists polled by the Financial Times. More than 40% of those surveyed said they expect the Fed to raise rates twice or more from the current benchmark level of 5.25 to 5.5%, a 22-year high. This is in sharp contrast to the mood in financial markets where traders in federal funds futures believe the U.S. central bank's policy settings are restrictive enough to get inflation under control, and so it keeps rates on hold well into 2024. Now, I don't consider these economists very astute people or versed in any basic real economics. You can see here in this paragraph, they're completely wrong about this. Once rates peaked, the economists surveyed were overwhelmingly of the view that the Fed would keep them there for quite some time. About 60% of those polled thought the first cut would come in the third quarter of next year. And this is where they are completely wrong, because we're going to hit a financial crisis before that time. What is it, the third quarter of next year or something? What did they say? Some long time they're going to be able to keep rates high in these 5.5%, 6% ranges. That is not possible because the dollar tank, the reserve dollar tank in the reverse repo facility is emptying out. And before we get to that, the importance here of this poll of economists is that it means that it is slowly starting to dawn upon the mainstream that we are indeed in the next price inflationary wave. And I will show you this from the Atlanta Fed's sticky CPI. They split the CPI into sticky versus flexible, and we'll see what happened in the 70s and 80s there compared to what's happening now. And you'll see that we're probably at the inflection point where we're at the next price inflationary wave. And if we are, and that is seeping into the mainstream Keynesian thought, then expectations are going to flip. And if the Fed does hike rates, it's going to look desperate. And if they don't, then people are going to fear more inflation, especially if we get an above expectation CPI coming in next month. It's going to start driving gold and silver prices a lot higher, a lot faster. And we're going to start entering, I think, the final phase of this explosion, boom thing in the monetary system, of course. So let's go to the Atlanta Fed. Right, we see here the Atlanta Fed. I'm going to move my face because it's probably in the way. The Atlanta Fed shows the sticky CPI versus the flexible CPI. The flexible CPI is the one that's a lot more wobbly, right? So we see the flexible CPI, meaning prices that change more often. This is like, it's sort of like the core versus the whatever is not the core, but it's not exactly that. It's pretty close. So the flexible CPI, which is mostly like food and energy and volatile stuff, it peaked out at 19.7 price inflationary rates in March 2022 and then starts really falling. And now we're at a point where it is falling absolutely year over year, minus 2.6%. But over the last 2 months, which we've seen in the CPI measures, we have gone back up year over year, and now we're at 0.4% year over year. But during that time, the sticky CPI 12-month year over year is still falling. We were at a peak of 6.7%, and now we are at 5.3%. But how long after the flexible CPI starts to rise does the sticky CPI follow? It takes more time because those prices are stickier. We're going to zoom out this chart and we'll see from there. Zoom into the 1970s, that same double wave that we saw in the PowerPoint presentation before, right? Sticky CPI basically bottoms over here and then starts rising. 1976, it bottomed at 3.2%, and it starts rising again in January 1977. And we see here that sticky CPI falls 6.1, 6.0, 6.0, and bottoms over here just after about 2 months, maybe 3 months, something like that. That's when the sticky CPI starts to follow. So that's when we saw it here. And also we see it here, 1972. So the sticky CPI is falling from 3.5, 3.4 to 3.2. And the flexible CPI is rising from June 1972, where it bottoms at 2.3, 2.5, 2.5 stays the same, 3.6. And then, so 3 to 4 months, something between 2 to 4 months is when the sticky CPI starts to follow the flexible CPI. And that's when the wave is really confirmed. Because if the sticky CPI is moving, prices are going to really start moving. And I think that's where we are.
Why am I drippings with goo?
You had a violent, prolonged, transformative psychic episode.
The last thing I want to show you is the reverse repo spare dollar tank. This was all the money that was printed in 2020, 2021 that did not make it into the banking system, and now it is going into the banking system. Then why isn't the money supply increasing? Well, it isn't. You look at a weekly chart of the money supply, which I won't go into here. I've shown it many times, but trust me, it's static. It is not expanding. So what is happening to all this reverse repo money? Where is it going? Well, I think it's going into plugging defaults. Perhaps loans are defaulting in big banks, and those big banks that have all this money in the reverse repo facility, they're using it to plug a hole in their balance sheet, so we would see a static money supply with a falling reverse repo facility. So here's the reverse repo facility, and something happened yesterday that hasn't happened in 2 years. First of all, this is the reverse repo facility. We see that it is going down pretty sharply since June 2023, which is when the debt ceiling fiasco was solved in a miraculous save by our glorious politicians who saved the US from default, and they should be awarded so we see it's going down here, and you see here at the right here, we see like a big swoop down here. We're going to zoom in on this in a second. So we're down to 1.4 trillion. We were at about 2.254 trillion over here. So we're down about 850 billion. I forgot the exact number, but if you do the math at this rate, starting from June 2023, we should be out of this tank. This tank should be empty by about February, March 2024, which is about 5 months from now. And if the defaults are what are draining this money out of reverse repos, then we're going to run out of spare dollars in around that time. And that is when we should see the final financial crisis, the final implosion, which will lead to the final money printing round, which will lead to the final explosion and the end of the current monetary system since 1971.
Check that door for heat, Tim.
If we go to the next chart here, this is the same reverse repo chart, but by day, the change by percent of the reverse repo facility every day. And you see here, I drew a line at where this line is. I think this was 6.2 or 6.15% or something like that. So here are all the instances on a daily basis when the reverse repos went down by more than 6.15% or whatever the exact number is over here. There were only 1, 2, 3, 4, 5, 6 times that this happened. And every time that we've gone down more than 6.15% in a day on the reverse repos, it has been on an end of month day. And an end of month day is a book balancing day for banks. So what they usually do is they put a whole bunch of money into the reverse repos on the day before to like minimize their cash, or however it works, I don't know, but there's like these huge fluctuations in the reverse repo facility for tax reasons or regulatory reasons or whatever the hell it is. So we always see these fluctuations, and there's no net change really, because there's like a big influx here into the reverse repo facility and then a big withdrawal. Right, same here, big influx, big withdrawal. These are all on end month days. This was the first day of October, the last day of September. This was the first day of August. This was the first trading day of July, the first trading day of April. Same thing every time. And this, of course, was the year end, right? This is when we had that huge influx, 10% change in the reverse repos because of year end. But what I'm saying is, it's now September 18th. Yesterday was September, the last trading day was September 14th or 15th or whatever it was. It was not a month end or a year end date, meaning this was something else. This was not a fluctuation. This was a withdrawal of about $91 billion, probably because there's a lot of defaults going on. And people would say, people would assume that the money is just going into T-bills, and it's possible that some of it is, but there is no arbitrage to be made between 1 month T-bills, which are about 5.4%, and the reverse repo rate, which is also about 5.4%. So there's no incentive for banks to stop collecting money from the Fed and instead collect money from the Treasury. There's no reason to do it because it's not a higher rate from the Treasury, and there's much less risk collected from the Fed, which can just print money and keep going. So I don't think it's coming from that. I think it's coming from defaults, and they're using the money to plug these holes in their balance sheet. We're at the cusp. A few months from now, this reverse repo facility will dry out, and there will be no more spare dollars to draw from. And then the defaults will really start to happen, and the Fed is going to have to print enormous amount of money when that starts, or enormous amount of dollars. So we're only a few months away from that at most. And the economists are starting to understand that we're in the next inflationary round here. So if you haven't noticed, the mining stocks and gold and silver have shown pretty good strength in recent days. I think the market is starting to shift seriously, and we're going to start to take off pretty soon. That is my personal opinion. And if you enjoyed this report, please sign up for a 2-week free trial of the End Game Investor at the link in the description below, because things are going to get crazy in the next few months. Or you can become my patron on Patreon, where I give a weekly commentary on religious and economic and government topics to placate and calm the souls of those who genuinely fear a terrifying event coming up soon. Don't fear too much. Just keep having faith and stay calm and prepare nicely, calmly, and rationally, and everything will be fine. This is Rafi with the Endgame Investor, and I'll see you guys soon.
It's pure. Pull the plug, boys.
Run free, little vermin.